In a groundbreaking turn of events, landlords across the nation have initiated a significant reduction in their rental prices to lure potential tenants into their vacant houses and apartments. This shift in the real estate landscape has the potential to catalyze a series of intriguing developments that could substantially impact the real estate market as a whole. The first ripple effect we might observe is a potential drop in both home prices and the overall cost of rent. While this may initially sound like good news for renters, it could have far-reaching consequences, especially as we delve deeper into the fascinating insights about the year 2024. Remarkably, 2024 is poised to become the hottest year for building multifamily units, a phenomenon not witnessed for several decades. The sudden surge in apartment construction is bound to significantly increase the housing supply, which, at first glance, seems like a boon for renters. More supply often equates to lower prices, after all. However, this influx of housing units may inadvertently put real estate investors in a bind. The heightened supply could force them to consider selling their properties, which could, in turn, drive down home and apartment prices even further. While this might seem advantageous for renters, the broader market implications are more complex than they initially appear. The main concern is that a decrease in rental prices might discourage potential homebuyers from making the leap into homeownership. If individuals find that they can maintain or even lower their current rental costs, as opposed to purchasing a home and incurring higher expenses, they might opt to continue renting. This is a significant consideration because a potential reduction in the number of homebuyers could stagnate the housing market. Now, let's delve into the latest trends in the rental market, which paint a somewhat mixed picture. Recent data reveals that 71 out of the top 100 cities in the USA have witnessed a decline in rent growth over the past year, with a staggering 70% of cities experiencing this decline. Notably, some cities are experiencing more substantial rent drops than others, such as Austin, Phoenix, Vegas, Atlanta, San Francisco, Salt Lake, Orlando, Jacksonville, and Raleigh. Conversely, certain cities like Hartford, Milwaukee, Chicago, Louisville, Kansas City, Providence, and Boston have continued to witness rent increases. The rental market, therefore, remains dynamic, with various opportunities and challenges across the country. To make matters even more intriguing, developers in Nashville are currently offering enticing leasing concessions, such as 3 months of free rent, equating to a 25% discount. While these deals may appear tempting, they have the potential to create issues for investors down the road. These rent cuts, combined with the surge in treasury yields, have the potential to adversely affect real estate investors. Traditionally, investors evaluate their real estate investments by comparing the return they can achieve, known as the cap rate, to a benchmark, often the 10-year treasury yield. Historically, the cap rate was higher than the 10-year treasury yield, making real estate investments an attractive option. However, with the introduction of rent cuts, investors might face a lower return than their benchmark, potentially forcing them to sell their properties. Additionally, the 10-year treasury yield has recently surpassed the cap rate. This means that investors can now potentially earn more by investing in 10-year government bonds than in real estate, a significant shift in the investment landscape. The current scenario in the housing market could evolve in two possible directions. If home prices decrease, it would make homeownership more affordable for first-time buyers and could provide a profitable opportunity for investors. Lower home prices would lead to an increased cap rate, making property investment more attractive. However, the housing market's high prices are influenced by factors such as limited supply and the escalating cost of building materials. Conversely, if rents were to increase, it could also raise the cap rate, making both home ownership and real estate investment more appealing. However, the reality is that rents have decreased by an average of 1.2% year over year in the United States, reducing the incentives for prospective homeowners and investors. Furthermore, it's important to consider the lag between the Consumer Price Index, CPI, and rent inflation. While rents are currently decreasing slightly on average across the U.S., the inflation rate for rent might continue to decline in the future. This could further impact the rental market and investor decisions. The recent surge in treasury yields, driven by concerns about inflation, has caught the attention of many. This concern is fueled by high retail sales and lower unemployment claims, which counterintuitively are seen as signs of an overheated economy. This presents a significant challenge for the rental market, as falling interest rates and rental prices could potentially disrupt real estate investors' plans. Furthermore, the discrepancy between commercial mortgages on apartment buildings and residential mortgages has significant implications. Commercial mortgages typically have shorter terms, lasting 5 to 10 years compared to the 30-year terms of residential mortgages. Apartment owners are increasingly seeking to refinance their properties, particularly as interest rates rise. This trend raises concerns about potential defaults and decreased property values, which could further lower apartment rents. While these challenges may appear daunting, some investors may see potential in distressed apartments purchased at discounted rates. They might opt to reduce rents to attract new tenants, further intensifying the competition in the rental market. Federal Reserve Chairman Jerome Powell is also contributing to the ongoing discussion with his predictions of sustained high interest rates. He suggests that interest rates will remain elevated for an extended period and expresses concerns about the current high level of inflation. This outlook may necessitate lower economic growth to achieve the desired inflation rate of 2%. Powell's warnings are grounded in historical data, which indicates that a period of below-trend growth is required to maintain stable inflation. One crucial aspect of this real estate conundrum is the impact of the COVID-19 pandemic. The pandemic has left an indelible mark on how we perceive and utilize our living spaces. As more people transitioned to remote work, the demand for larger, more comfortable, and often suburban homes increased significantly. People sought spacious residences with home offices, outdoor areas, and features that catered to their new lifestyle needs. This shift in demand pushed home prices higher, particularly in suburban and rural areas, contributing to the ongoing affordability challenges for first-time homebuyers. Simultaneously, the pandemic has reshaped the rental market. The rise of remote work led to a surge in demand for short-term rentals in vacation destinations and rural areas. Airbnb and similar platforms witnessed a spike in bookings, as individuals sought to escape urban centers and opt for more secluded accommodations. Consequently, traditional long-term rentals faced increased competition, potentially leading to a drop in rents in certain urban areas. Another significant factor influencing the real estate landscape is government policies and regulations. The implementation of eviction moratoriums and rent relief programs during the pandemic aimed to protect tenants and provide financial support during challenging times. While these policies offered crucial relief to many renters, they also created dilemmas for landlords, especially those who rely on rental income to maintain their properties. As these policies are gradually lifted, the balance between tenant protection and landlord sustainability will continue to be a point of contention and a factor affecting the rental market. Moreover, the real estate market's dynamics are closely tied to broader economic conditions. The Federal Reserve's monetary policies, as exemplified by changes in interest rates, play a pivotal role. The housing market is highly sensitive to interest rate fluctuations. When interest rates are low, borrowing is more attractive, making homeownership more accessible. Conversely, rising interest rates can deter potential homebuyers and impact affordability. While the Federal Reserve has expressed intentions to maintain higher interest rates for an extended period to combat inflation, it's important to consider the interplay between these actions and their effect on the housing market. Rising interest rates may deter some homebuyers, potentially leading to a slowdown in the housing market. At the same time, it can encourage real estate investors to explore alternative investment avenues, such as government bonds, which could further affect the supply and demand in the real estate sector. Additionally, the broader economic landscape, including job markets and wage growth, plays a significant role in the real estate equation. Employment and income levels directly influence people's ability to rent or purchase homes. Job security and increasing wages can boost the demand for housing, while job losses and stagnant income growth can lead to lower demand and increased affordability challenges. Inflation is another critical economic factor impacting the real estate market. Inflation erodes the purchasing power of currency, making goods and services more expensive over time. This includes construction materials and labor costs, which have both seen notable increases in recent years. The higher costs of building materials have contributed to the elevated prices of new homes. Consequently, lower housing supply and rising costs may continue to put upward pressure on home prices, making affordability a persistent issue. Another important trend to monitor is the growth of the technology sector and its influence on the real estate market. Cities with burgeoning technology hubs have experienced heightened demand for housing, often leading to soaring home prices. The concentration of high-paying tech jobs in these areas can create a housing supply-demand imbalance. However, the rise of remote work may potentially alter this dynamic, as people can now live in more affordable areas while working for tech companies based in expensive urban centers. The sustainability and environmental impact of real estate development are also increasingly on the radar. With growing concern about climate change and environmental conservation, sustainable and eco-friendly building practices are gaining traction. As a result, developers are under pressure to adopt green building standards and incorporate energy-efficient features in their properties. This shift towards sustainability may impact the cost and desirability of housing, as eco-friendly homes are often associated with higher upfront costs but lower long-term utility bills. It's worth mentioning that real estate is also influenced by demographic trends, such as population growth, urbanization, and generational shifts. For instance, as the millennial generation enters its prime home buying years, their preferences and housing needs are reshaping the market. They tend to prioritize affordability, proximity to urban centers, and sustainable living. This demographic shift contributes to the changing dynamics of the housing market with potential implications for supply and demand.